Buyers don't pay for growth alone. They pay for predictability, transferability, and risk reduction. And most businesses fail that test. Today, we're going inside the buyer's mindset. Not theory, not service level advice, but how deals actually get evaluated and where they break down. Today, I'm joined by Robert Indries, managing partner with Oak Ridge Advisors. They work directly with founders on M&A transactions, capital advisory, and exit preparation across multiple industries and deal sizes. So here's the real question. When a buyer looks at your business, do they see a scalable asset or a risky operation? That's what we're breaking down today. Robert, welcome to the show.
Thank you so much, Joe, for having us.
Yeah, glad you have on. I know we had Patrick on a couple months ago. So I'm super excited to hear a second level of everything that you do with your clients. So if you're cool with it, let's jump right in.
Beautiful. Let's go.
Awesome. So from your perspective, what separates a good business from a sellable?
Most businesses, or the vast majority of businesses, aren't good by our definition, right? I like the term of a glorified job. That's basically what people create for themselves, right? And for example, recently I've been to a wellness studio here locally, and they had a number. I called the number, spoke to a lady, right? Lady said, I won't be there tomorrow, but you can talk to someone else and so on. But I would really like to be there, and etc. And, she kept sending me stuff and I kept talking to her. But then I realized she's the founder. Right. I was literally one phone call away from the founder, and then the founder was, onboarding me, selling, and so on and so forth. And I told her, because she was, making small talk, I told her what I do. And she said what almost everyone says, that I am part of the brand. And I said, no, then you don't have a brand. But then it's just you. Because when someone buys from Nike, they don't buy from, the guy that founded Nike. They buy Nike because Nike is a brand. You do not have a brand. Because if you'd have a brand, you wouldn't need to be here, right? I hope it struck home, in a very loving way, the way I meant it, right? And so we had that conversation. We even wrote a book on the subject. I gave her a copy of the book. She gave me some free protein powder, so that was fun. But it was just like a nice exchange, right? Like she was willing to learn, willing to go in that direction. Again, you might think that, you have a good business, is profitable, etc. But the reality is that we don't really see good businesses, right? Just to give you an idea, in the last quarter before this one, we had 384 businesses that applied to want to sell themselves, right? 384. You will not guess that out of those 384 people that said that, hey, I raised my hand, I want to sell my business, less than 5. 4 of them went to LOI. That's it, just 4, right? So 1% of them. Imagine, and the other 99% probably thought that they have something to sell, right? But the reality is that the moment you remove them, you remove sales, you remove HR, you remove all your connections to all the past important clients, you remove almost everything. And so all of a sudden your business is worth almost nothing. Because if I start from scratch and I just put the same amount, by the way, because you might be asking $1 million. Well, guess what? If I start a business right now, and if I have $1 million to spend, I'm going to create one that's better than yours and less dependent on me or you or anyone else for that matter, right? Because that's a lot of money still, right? So you can invest that and just build it from scratch at that point. So good businesses, very rare, as per the definition of how we define good. And then good businesses compared to something that's ready to sell, the only difference is how transferable it is, right, to someone else, right? A good business in and of itself can operate very well without its founder because it has very good culture, very good management team, everyone's competent and they're still doing everything, and the owner can just leave for a month. However, when someone looks to buy, they don't just look at that. They also look, okay, where are all of the leads? Do you have a CRM? Right? Where's the procedure of onboarding? Where are the processes for customer success and so on, right? And if all of those are missing, it's still very risky because you then need to talk to every single person in every level of the business to extract the business, right? Okay, what are you actually doing on the day-to-day? So again, the business can be good. It can operate perfectly well without you, but it's not transferable. So that's the only difference between good and ready to sell, right? That transferability of the asset.
I love that you're speaking my language right now. I tell my clients all the time, it sounds like you have a celebrity persona business, not a transferable. Because it depends on you. And then obviously the transferability of having those documented systems and everything like that. It certainly increases it. Where do you see the biggest disconnect between how founders value their business and how buyers value it?
I think the biggest disconnect is in wishful thinking, because you've worked on this business for 10 years, maybe 15 years, maybe 20 years. You really don't want to be told that it's worth $500,000, right? Or $1 million or whatever. You want to believe it's 5 million or something, you want to believe it's a 5 million a year revenue. You're going to sell it for 5 million. And then when we look at the books, you're making 800 grand adjusted EBITDA, right? So you're really only gonna get maybe 2 point something, on a very good day, on it. And you don't want to believe that. You want to believe what the best-selling broker tells you. Oh, no, work with us. We're gonna sell it for 5 million. We see that so often. It's literally one of the biggest cancers in our industry. The brokers that agree with your valuation of your own business. It's like literally the biggest gap, because then they fool you. They say, no, yeah, we can sell it for 5 million, of course. And then you're committed to them. You sign a contract, you're exclusive, you're whatever. They try to sell you or sell it to someone, and they obviously fail, right? And then the people like us, because that happens to us sometimes, we have relationships with brokers and so on and so on, and they send us deals. They send us a deal, that they valued at 5 million. We go back and we're no chance this is worth more than 2.5. No chance, right? And then the broker tells us that, yeah, that sounds reasonable. But they already set the expectation with the seller at 5 million. And so it's on them. They made the mistake, right? Obviously, and I want to be very let's say, lenient towards the broker, because the reality is that if they wouldn't have agreed, in quotes, in principle, with the seller's self-valuation, they wouldn't have gotten the seller as a client, right? Because the seller would have just gone to the next broker. So this is the problem, right? Because people compromise, right? The broker knows it's not worth 5 million, yet they say, yeah, sure, it's like in real estate. You have a house, you think it's worth 5 million, you work with a broker that agrees with your own valuation, and then all of the bids come in at 2.5. You're like, oh, we're not selling at 2.5. You said it's worth 5. Well, yeah, but the market will give us feedback, and then they backtrack what they said. Is just not nice. So that's the biggest gap, because you think it's worth X, and the reality is in the current market that it is worth Y, and Y is many times half of X or whatever. And so that's the only thing, because the reality. That if you wouldn't be there, Josh would quit the next day. And that if you wouldn't be there, Michelle would have no idea how to deal with that client. And blah, blah, blah. And I can keep going on and on. These things, right? I don't need to tell you. But you still wish that, maybe someone doesn't care, or they don't find out, or something, and you can sell your business at the premium, which I'm sorry, but if you're working with anyone that knows what they're doing, it's not worth that much. And so what you need to do is you need to give the business to someone that can transform it into an asset that is then worth 5 million, right? Or do it yourself. There's enough books, there are enough amazing podcasts like yours, they can learn what they need to do. But the reality is that if you haven't done it in the last 10 to 15 years, chances of you doing it now are very slim. So just work with someone that can do it for you, and that's it. And you pay them maybe $500,000, but you get an extra 2 million at the end of that. It literally has a fixed ROI. It's 10 times better than the stock market in most years.
Couldn't agree with you more. I call it the fantasy mindset. Fantasy mindset that my business is worth 5 million, but when we look at the P&L and the balance sheet, and we create an adjusted EBITDA based on the stuff. Hey, it's at 2.1. We could potentially push that to a 2.3 or 2.5, and we create some really cool performance earnouts for you or something. But we're not going to be able to get 5. And I end up saying no to clients all the time, because I'm not going to try to say it's worth what you think it is. It was excellent. I couldn't agree more. Your language and exciting the heck out of me right now. So let's continue because now I'm curious. You recently highlighted that AR, accounts receivable. Why is that such a critical signal, specifically during due diligence?
Well, because it shows business continuity, right? If your AR is 0, then I'm not buying anything. Why would I give you any money because your AR account is 0? You have nothing to collect. So the businesses that sell for the highest premium are the businesses that can show recurrence of revenue from the same clients for multiple years. Exactly. So that's what you need. And so if your AR is 0 or close to 0, I'm basically just buying the case studies that you have, right? Like, oh, I've worked with XYZ client in the past and ABC client, a year before that, et cetera, et cetera. So I buy that from you, but that's not worth a whole lot, right? What's worth a lot is the accounts receivable, and I'm glad you pointed that.
Yes, the four pillars of preparing for exit. I got to make sure you got recurring revenue, documented systems, honor independence, and a transferable asset. Again, you're exciting. This is like one of the best podcasts I've had. No. What does poor receivables management signal to a buyer?
Well, a couple things it can signal. So if everything else is on point, it's in the green, it can signal an opportunity, right? It's like a signal for, hey, I can go in and I can improve accounts receivable, collections, et cetera, and then basically I can, let's say maybe it's a $10 million business per year, right? I can maybe take that to 12 million because of my forecast, because of what I've noticed is missing in terms of accounts receivable, right? And so that's the number one thing we look at. We never look at one thing extrapolated from everything else. We always have a holistic view. And at our top level of analysis, we have like 160 something questions. We take 2 days to go through all of them with the people that we work with, and 2 days just to get answers to the questions. And then after that is the analysis of whether or not those answers are actually true, which can take a month or 2 months or whatever. But let's say everything else is green. You have issues with accounts receivable. Okay, maybe that we can fix that and we can find out how based on all of your answers, so that we can see, okay, I'll give you a little bit of a discount because, still you have an issue, something's in the red. So anything that's in the red basically means that you need to give us a discount because we need to go in and fix that. At the same time, you can tie that discount, if you trust that your company is worth what it's worth, to seller finance. And 100% of the time we're willing to do that, like no problem, right? You're willing to stay on for X number of months or years, whatever, until we get to that 12 million, which we think we will, right? Then you can earn out the rest of what you think it's worth, right? Because you basically put your money where your mouth is. You said, no, I've made a mistake. I know I've made a mistake. I'm humble about it. You guys can fix it, right? And I want my money. So, okay, I'll give you 4 million right now, another million in a year or two, whenever that occurs, basically, or the 12 million in revenue occurs. So that's what it tells us, number one, if everything else is in the green. If multiple things are in the red or yellow, right, then it's just a systemic issue of mismanagement. It's just one variable of 100 other variables that can go poorly, right? And so another thing, it can be marketing. You can have issues with marketing. You can have issues with retention, right? And retention can lead to a poor AR, right? Like you can't retain clients for more than a year or two. You can see average client lifetime value is 1 to 2 years or whatever it is. Maybe it's even just one purchase. So those type of things, again, in the vast majority of cases, they tell us that there is opportunity, right? Let's say you're a shoe store, you sell shoes, and we know that because you're a shoe store and you only sell shoes, there's an opportunity to sell purses and bracelets and scarves and other items of the same colors of the shoes, so that whenever someone buys blue shoes, because, hey, you bought the blue shoes, do you want the blue scarf or a blue whatever, and so on. And we've done this so many times with retail, right? Incredible how much then people see us as a brand to go to for all of their accessories, or if it's something else, maybe you're in real estate. And so the only thing you do is sell property. Okay, well, that's not a good business model. You should sell the property, then you should sell maybe cleaning services. Like obviously you don't do that, but you have partners, right? I sell cleaning services, mortgage, services, maybe remodeling, drywall, roofing. Like you got to have so many things. Like whenever someone comes to you to buy a house, everything related to that house you solve, You become the, hey, Joe, I need a new fence. Hey, Joe, I need paint. Hey, Joe, I need whatever it is. I always come to you. And now that's a business that has recurrence and recurrence and recurrence. And so again, if you're in real estate, people buy from you once every 20 years. That means you don't know business. I'm sorry, but it's just that's just, you don't know. But you might know real estate. You might be amazing at real estate, but then you need to hire someone like us to actually build a business behind that real estate portfolio that you have, so that if you want to sell your real estate empire, right, in 3, 4, 5 years, you can actually get 10, 20 million for it, right? And so that's basically what makes us think about in a nutshell.
I love that. Couldn't agree more. Add-ons, complementary services, affiliation programs to get other vendors that can assist you, like in that real estate example you just mentioned. All those things. Couldn't agree. How does working capital show up in the deal structure?
Well, I mean, some businesses are very working capital reliant. And so let's say recently we're looking into a company that's within the properties, like they do renovations, etc. So in order to function as they should function, they need minimum 3 million of working capital for the given year, right? Because they need to buy things in advance and then they get paid after the job's done in many cases. So it doesn't make sense for the owner to take out cash on exit, right? Like let's say they have 2 million in cash right now. They want to exit. They expect us, let's say the business is worth 5 million. They expect us to pay 5 million, and they also want to take out the 2 million in cash. And we say that's 7 million. That's not 5, that's 7. Well, no, this is my money. No, that is the company's money. The company needs that money to function. When it's a company function, that's working capital. We're not talking about owner discretionary cash. That's profit, net profit. Fine, you can keep that. We're talking about working capital. If the books for the last 3 years tell me that I need 3 million in working capital, I'm actually 1 million short because I only have 2 right now. So I actually need to maybe put in, right? So if I give you the 5 million for this business, I might actually be in the situation 3, 4, 5 months from now where I need to put in another million, right? Because I need to collect on other projects, to survive until the end of the year. And that's extra risk on my end. I might actually negotiate a discount because of that risk. And I might only give you 4 million with 1 million as seller finance so that I can make sure that I don't need that million, right? Or don't need to put in that extra million, right? So we agree on the 5 million business worth, but that's it, right? So I give you 4. And if I need to put the 1 million into the business, that's on you. If I don't, if what you say is true, that the business will collect on that million and will be self-sustainable without a further investment, that's fine. I'll give you that same million, right? No problem. So that's what that means. And again, there's a very big difference between working capital and discretionary cash, right? The two couldn't be farther apart. The discretionary cash is yours. You can take it out, no problem. And working capital has to stay in the business. And if it doesn't, only thing it does is that it goes like, instead of me giving you 5 million, I give you 3. You take that 2 out, and I need to put another 2 back in. We just do some financial gymnastics, but the value of the company always includes working capital.
Love that. And I couldn't agree more. Virtually every client that I've ever worked with thinks they are selling for X, but then we got to do the working capital adjustments, holdbacks, true ups, like all those kinds of stuff. And it changes, or to your point, you create this level of financial gymnastics that you have to do to get them to get what they think they're getting, because all those things are stuff that has to be taken into account. What are the most common diligent findings that reduce evaluation for a business?
The most common ones I'm thinking now is adding back things that should not be added back, right? Like whatever you add back, I don't know, maybe gas, that you use to go from A to Z, right? And you say, well, it's my car. Well, yes, but you used it as a company car. And so whomever we put in your position will have the same routes. They'll need the same gas. You can't add back that. You can't adjust that. That still stays as a cost, as an operating cost, right? Okay, it's not a direct cost, right? It goes below a gross profit, but it still is an OPEX, right? Like you still need to make that expenditure, or the car itself, right? Say, well, it's my car. Okay, but the new person will need a car, right? So, okay, you can keep your car, but then we'll have to buy another car, right? And then we'll have the same lease, right, to pay on that one, or whatever it is. So that's the most common one, right? Like people add back stuff that are actually business expenses, right? But they somehow, in their minds, they think it's not. Sometimes for honest reasons, and we have a simple 30-minute conversations. They understand. Only issue that happens then is maybe, let's say, they think they have $1 million company, and that's maybe worth 4 million is an exit, and we realize that it's actually 800 grand, because 200 grand shouldn't be as add backs. The problem is that now is worth 3 million instead of 4. So because 200 grand goes down, it's not a 7-figure EBITDA company anymore, it's a 6-figure EBITDA company, and that 200 grand might mean a million lost or 800 grand lost. So, right, it's closer to 2 million than to 4, and now they say, no, impossible. Just because of these add backs, you're taking away $1 million. I'm like, well, it's just a math problem. It's not like I'm taking away $1 million. It's just not worth that extra $1 million. I didn't take away anything. It's just it was never there to begin with, right? Like, you have the fantasy that it's worth 4 because of these miscalculations. But when we calculate it correctly, the reality is it's worth 3.2, right? And that's it. I didn't take anything. It wasn't worth 4 to begin with, right? And so that's the most common one, because that's where most things break. And then the next common one is basically people think that it's very easy to replace staff. But the reality is it's not. You've been working with Frank for 5 years. Frank knows everything, right? And that's the reality. It's just like anything that happens, Frank can do, right? But then if I buy the company, right? If Frank is the know-it-all, be-all, everything, whatever, like he is the Lord and Savior of any situation, I am at his mercy, right? Whatever, if he asks for a raise, right, he wouldn't have done this to you because you and Frank are friends. He has no loyalty to me. So if Frank right now is paid 100 grand, and industry average is 150, but you were giving Frank money under the table or whatever arrangement you had with Frank, right? Or he's your nephew. I don't know, I'm making stuff up. But basically, industry average might be 150 grand for his role. He can very easily demand a 50% increase in his salary, and I could not do anything about it because I have to give him what he's asking for. And so that's another thing that people underestimate, how difficult it is to replace, employees. You're not selling a McDonald's. That's nothing is as optimized as McDonald's or KFC or whatever. I can't put a 15-year-old in and they just assemble things. I was literally I bought something from, where was it? Wendy's. I bought burgers from Wendy's, right? And the person I was with, they say, hey, let's just buy some Wendy's. I said, fine. We haven't bought from Wendy's in like 10 years. And I said, okay, let's do that. And we bought Wendy's, and we were in between 2 burgers. We both wanted both, so to speak. And so I said, okay, let's just buy both, and then we half each one, and then we have each one half. I said, okay, perfect. So we get the burgers, and I noticed there's no a knife, and I didn't mind because I didn't really need a knife. But then I asked the people behind the counter, like, could you please cut these in half? And they're like, no, we don't have knives here. And I got a blue screen. I'm like, you're a restaurant, what do you mean you don't have a knife? And not one in the entire institution, right? And they're like, well, everything comes cut to the exact thing it needs to be. Like, we just literally assemble and put it in the oven and give it to you. And I was looking at, oh my, that's the business I want. What, you just assemble, like, literally? And I looked back, I don't think anyone was above 19 in that place, right? Like, literally maybe paid who knows what an hour minimum, right? They're probably all, in high school or just going to college, whatever. That's way well oiled. They don't even have a knife. You don't need to cut anything. Just have the salad. So that's when it's easy to replace. So that's 0.01% of businesses or less. I'm not even exaggerating. Every other business needs Frank, right? And then when Frank is replaced, we have a problem. So those are, let's say, the 2, and I don't want to give more, but these 2 are almost always.
Couldn't agree more. The quality of earnings always comes up as well, but those are absolutely the top 2 that I see consistently as well. So I double down on exactly what you said. What are the quiet risks that founders think don't matter, but buyers know that they do?
The longevity of a business. You say, oh, I've been in business for 15 years, it's fine. Okay, but you've been there across all of those 15 years, and your family's livelihood depended on you being there, right? If the going got tough, you still showed up and you did everything necessary because your children needs the college fund, right? And your wife, you promised her a vacation wherever, etc., right? And so you woke up and you put in the weekends and you did everything. But we cannot assume that the next person in charge will take this for another 15 years. I see longevity as the number one biggest risk that is underestimated by almost, or I guess every single founder I've ever spoken to, right? Because I have this business since forever. Yes, in your lifetime. But forever for me might mean 2 years. You know what? I don't know what forever will mean to me. If I want an ROI, if I give you a 3x EBITDA, you need to understand that I need to operate the business for at least 6 years. Why? Because part of the money is taxes and EBITDA is after taxes. But it's not like I will stop paying your taxes. So, okay, you get a 3x multiple on EBITDA, but I don't make my money back in 3 years, right? Because I have 40% taxes or whatever taxes are, right? And so I need 6 years. And I'm not exaggerating because money devalues. So if I give you 1 million right now, 1 million in 6 years might be worth, 1.2 or whatever, or it's worth less. It might be the equivalent of 800 grand, right? Or however you want to calculate it. So I actually need to make more. So the business needs to survive and let's say thrive in the same way it has until now for minimum double the amount of the EBITDA multiple. If you want a 4x EBITDA multiple, I need to make sure that that business stays on for 8 years. 8 years. So when I tell this to founders, they either are in shock and they don't realize how big this risk actually is for the buyer if they're humble and they do the math. Or number two, they don't want to hear. But they go into their bubble of understand. They don't care. They're like, this is what it's worth. This is what I need to be paid. They don't care that the next owner needs 8 years to make their money back. They just give me my money. And so these are the two different types of reactions typically that you get. Obviously, I prefer to work with the first guys that understand that, oh my God, yes, that's risk. Even if the price doesn't change, but at least the humility, the humbleness of, oh my God, this is big risk for you. I really hope it goes well. That's it. Like basically, because once they sell. It's not their problem anymore. But it's nice to at least have that understanding. And maybe 2 years from now, you need to give them a call. You really need, like, Joe, I'm sorry to say, Frank just quit. He just quit. He didn't say anything, no notice. He just quit. Please help me. I need to find another Frank, or can I pay you to help for a little while? What can we do here? Because the business won't operate without him, right? And so it's good to have a humble Joe on the other side of the phone to say, sure. Let me try to help. Let me do something. I want you to get an ROI. That's the relationship. That's stellar. That's the level of nobleness of Christian values, we call them. Like actual virtues that you want people to have. And so if we would have all people be like that, we would never lose money. It's just like we would always make an ROI. But the problem is most people, or not most people, sorry, no, I'm lying. Some people either lie intentionally or unintentionally, or otherwise really don't want to help you in any way, shape, or form after the deal is done, right? They have their money, they just disappear or ghost you or don't reply, once in 2 weeks, maybe, whatever. And again, I'm not saying everyone's like that. I'm saying there are some people out there that are like that, and that makes it difficult. So far, we're very fortunate. 100% of our clients got a return on investment so far, right? Return on their investment. So we're in a very good place. We always lead with fairness. So we want the seller to get the best possible amount for their business. We don't want you don't need to lose for me to win. Both of us can win. Let's look at the actual numbers. Let's look at the actual worth. I will pay you what it's worth. No problem. No questions asked. And I can argument every single discount, every single decision, every single thing, because I've been doing this for a long time. And you can run this by Joe. You can run this by anyone in the industry that actually knows what they're talking about. They will confirm everything I said. This is the value. Here's the money. Do you want it or not? Right? We have 200 million to invest, and we can't find enough businesses to buy, right? 200 million, literally. Like someone with a healthy business that's listening to this right now, reach out to me. I have money. I want to give you my money. Give me a healthy business in return, or let's prepare it to be healthy, right? If it's not ready right now, let's prepare, let's get it there, right? And so very difficult to find good or businesses that are ready or that have an owner that's humble enough to understand that they need to make an investment into the business before they can get the multiple that they dream of.
Love it. I love it. All right. So everybody, he's got 200 million to spend. Let's find a way to help him spend it. So with that in mind, you're now the buyer. So how do you validate? Because you've referenced recurring revenue earlier, specifically in the AR world, but how do you validate that the revenue is repeatable above and beyond just looking at AR?
Well, some of the ways you can do it, if it's like an important deal, especially if it's, a lot of millions, tens of millions, etc., you tend to have interviews with the client as well. So you sign a lot of paperwork, non-circumvention, etc., etc. So God forbid you go against any of those terms, because you can't close shop at that point. The lawsuit is going to be so low. Because like if like the deal is worth 20 million, we say in our agreements that if you do anything stupid, you or us, we need to pay for the value of what was lost in a potential transaction. So if it's a $20 million transaction, you're basically liable for 20 million at that point. So you never go against the articles. But so you have interviews with clients, and you want to understand, why are they actually buying from? Are they buying because of Joe, or are they buying because the product is amazing, right? And that's a very big difference. Because if they're buying because of Joe, the quality of earnings isn't that good, right? Like it's good, because they won't want to let Joe down, and Joe can ask them nicely, like, please stay with the business, don't churn, because I'm selling it, be nice, etc., etc. So he can do that, right? But at the end of the day, Joe leave, right? And then a year from now, people will even forget Joe was there. New clients, when they need to pay for the next year, and they'll be like, you know what? I don't want to work with Robert anymore, or Patrick, or anyone else. I want to work with someone like Joe, because I really like Joe, right? Nothing against you, Robert, but I really like Joe. I want another Joe, right? And so then that becomes a problem. And so there are ways in which you can ask those questions, right? So that you find out. We're helping someone exit, and they were one of our clients. Or sorry, we were their clients. So we were buying services from them, 6 figures a year, right? And they were selling their company, and we were helping them through that. And they negotiated that all cash that they collect before date X that they should keep, and anything after that is, the new businesses. I swear, this guy called me, said, Robert, I need a favor. Could you please pay for all of the next year in advance? I'm like, why would I do that? Oh, because I keep all of that money, right? And then it's like, dude, come on, you're pulling one. It's like, you really shouldn't be doing this. Well, yes, but at the end of the day, we negotiated this, blah, blah. And he explained, I said, okay, you know what, fine. And I literally, gave him a significant chunk of cash, and then he kept it, right? He kept the cash. And he did explain, it's very high margin, they're not really gonna feel, the lack of revenue, et cetera, fine. And so just for the sake of it, it's been like almost 3 years. We have had many issues with the new owners, but we still didn't churn out of a case of ethics, right? Like because we know we paid in advance, and we did want to, make it worth the while of the new owners as well. So we're still with them 3 years later, and we had a lot of issues. And we're telling them, this is a problem, fix it, please. We don't want to go to your competitor, and we're getting emails from your competitors all the time, but we want you to fix this, not for us to leave. It's okay, yes, please, thank you, blah, blah, blah. And so we have to some extent, I think we have an even better relationship now with them, because they really take us seriously. They know that if we give them feedback and they apply the feedback, we will not churn. We will stay with them for as long as we get the service that we want, right? So it actually ended up fine, right? But these are some of the things, that people do when they exit. Like, it depends on what they negotiate. So at the end of the day, that's something that you do. Like, you have interviews with the clients, and another thing you do is you look at the amounts that they pay. Are they paying the same amount year to year? Are they paying more year to year, or are they paying less year to year? And that's a very important distinction, Because if they pay the same amount, you can say that the business is stable. Wrong, because since last year there's been 7% inflation. So they should pay at least 7% more this year compared to last year. If for the past 3 years they've been paying the exact same amount, you have a problem. Because that means the business is going down in the market share value of things, right? If they're paying a little bit more, at least as much as inflation, okay, fine. If they're paying way more, like let's say 10%, 20, 50%, like much more, that's amazing quality of earning, because that means you don't only deliver that people want more from you every single year. And finally, if they pay you less year on year, even though you have the same recurring revenue, you need more and more clients every year to sustain that recurring revenue, which now is a quality of earnings.
100% agree. That literally goes back to the landscaping business where we bought several firms that had been around for quite a while. And virtually all of them had never given a price increase to their customers for years and years and years. And obviously, one of the first things we had to do was try to true that up in some way, shape, or form as quickly as possible, because it was deteriorating margin and therefore deteriorating the valuation of the company. So I love that you spoke that, because I've lived and breathed that 7 times over. Couldn't agree more. If a founder is interested in selling, when should they start? How far out before the actual deal should they begin the preparation process?
Well, I mean, I'll say something that might sound surprising, but I think they should prepare to sell from the day that they incorporate. There's absolutely no reason not to do that. Every single metric that makes you good to sell makes you good in business. That's what we're looking for. We're looking for how qualitative is this business? How well is it running, right? That's what we're looking for. So you should basically start with the end in mind. Prepare, even if you never plan on exiting, buy our book, buy The Elkridge Path, buy Unshackled, another book we wrote. Like, buy books on business and how to structure business, and then structure your business that way from day one. You have absolutely no reason not to. Like, literally, why would you want a business that's dependent on you, right? Like, you can't go on vacation. If you're sick, do you have issues, right? Or anything else. Why would the books not be right? Why would the processes not be repeatable? And so you can expect the same outcome consistently instead of chaos all around, etc., etc. Prepare to sell from the first day in business. No reason not to do that. We have written books on the subject, and there are many books written by other amazing authors that have had the same experiences, and they will tell you the same fundamentals, right? We just implemented them differently and explained them slightly differently. Whomever you resonate with, just buy the book, right? And then prepare yourself for an exit from day one, if you can.
I love that. That quite literally is what I say all the time. You should start preparing for your exit when you create the company. If you didn't do that, then the best time to do it was the second day that you incorporated. And if you didn't do that, then the next best thing is today, whatever today is, because you're behind the 8 ball. We have to catch up to do. I love it. And we're simpatico when it comes to that. You referenced a minute ago that you're looking for quality, good businesses to buy. So if somebody out there believes that they have a business that you should be interested in, how do they get in contact with you and your team?
They can literally Google my name at this point. We've had so many people take our interviews, and we've been featured in Forbes, Inc., Entrepreneur.com, etc. So literally, if they just Google my name, they'll find me. In terms of, that's probably the simplest thing that you can do, because I guess it appears in the title. But basically, they can also just Google or go to elkridgeadvisors.com. There's a form there. They can mention in the form, right, that they heard about us in the podcast, etc. They have a business. Even if it's not ready to sell right now, get in touch. Let's maybe just hop on a consulting call. Let's see if we can help in any way, take you in that direction. If you're ready to sell, we have money right now. Let's go. No questions asked. We're a little bit behind on the quarter for how many acquisitions we want to make. So, because we just didn't find enough, right? Even though we have hundreds of people telling that they want to sell themselves, very few are actually ready to do. And out of those 400, some of them were actively engaged in trying to grow their companies, right? Like they're hiring us to do that, right? To get them to a place where they sell, but that will take time, right? So that might be a next year exit, right? As far as they're concerned. But for right now, again, or an email can be office@elkridgeadvisors.com, or even Robert@elkridgeadvisors.com. You can definitely, if you want to sell, you will find me. No problem. Just reach out.
Love it. And just to make it super simplistic for everybody, scroll down in the comments. We'll put the links to the social channels, the form on their website, all of that in there. So if you want to go Google them, go Google them. But it can also be in the commentary just to make it super quick and easy for you. Robert, this has been fire, my friend. Thank you so much for taking time out of your day. I know you're super busy. You're trying to evaluate, you're trying to advise clients, you're trying to do deals. So the fact that you took some time out of your day to be on with me and my audience, I sincerely appreciate it.
Thank you so much as well for inviting us.
Of course, of course. And for everybody that's listening, if you're a buyer, ask one question. Can the business operate, grow, and produce cash without the current owner? If the answer is no, then it's not a sellable business yet. If the answer is yes, then you're looking at an asset. So again, we shout out to Robert. Appreciate him coming on, breaking those down. If you're building towards an exit or even thinking about one, start here, clean up your financials, build your systems for KPIs, produce your own founder dependency, because that's what buyers can really pay for. Reach out to Robert and his team, or feel free to check out our website, twillingtx.com. We'll be happy to assist you as well. Until next time, continue to lead, manage, and thrive to create a legacy to last. Have a great day, everybody. Appreciate you all.